picking back up with question 47. Now, a couple of things. Notice that that last question, it was one question, right? And we had all the little tabs down there at the bottom. Notice that this one says questions 47 through 50, so 47, 48, 49, and 50 are all related to one another. So instead of it just being in one question, it's in a couple of different questions. So, a couple of things to note here, right? It says the Sky Blue Corporation has the following adjusted trial balance at December 31. Now again, remember, you've got to make sure that you understand where you are on the timeline before you pick up with a problem. Okay? So, at this point, y'all want to join me on the calendar? So, on this question, when you're thinking through, it's like, okay, what has already been done, and where do I need to pick up and move forward? Now, as an accountant, you're going to do that all the time, because that's where you live is, okay, what have you already done, and where do I need to pick up? Okay? So in this one, when they tell you that this is an adjusted trial balance, what has already occurred?
Adjustments.
Okay, so we've done the daily entries and we've already done the adjustments. Okay, so in the last one, remember we picked up with an unadjusted trial balance and did the adjustments. Now we have an adjusted trial balance, and now we've got to pick up from there. So remember that when we have an adjusted trial balance, now what's the next thing that we can do? The financial statements. Okay, so in this one, they ask you to put together the income statement, and then it says how much net income did Blue Sky Corporation generate during the year. Okay, now on that one, all they're asking for is just a number. Okay, so from your perspective, you're just simply going to have to lay out that income statement. Now again, I would highly suggest that you come down here to your snipping tool, create a new snip, pick up this group of data right there, throw that over to one side, and then pick up from here and fill in your income statement. All right, so take a few minutes. All right, so when we're looking at our adjusted trial balance, don't miss this, right? The grouping that you're picking up is all this right here. Now, the only thing that may change in a later question is we might have dividends in there, dropped in sort of in that, near that grouping, but we're not going to include dividends because remember, dividends go on which statement? The retained earnings statement. So we start with the income statement, we pick up all those items, we move them over here, we put them in order of largest to smallest, no matter which grouping, and then down here under the expense side, just remember that income tax expense comes last. Now, here's the thing. Is it going to mark it wrong if you put it in a different order? No. But the correct order is largest to smallest with the income tax at the end. Okay? All right? How we doing? Okay? So, we get the 4910 on the income statement. It then asks us how much net income did the Blue Sky Corporation generate during the year? Well, that's just simply the 4910. Okay? So there's the first question on that one. All right? The second question, hang on a minute. Please stand by. View. Okay. So I'm still on instructor view, right? There's the income statement, right? Okay. Now for you, this is the next question. Okay. I'm just scrolling down, but for you, it's the next question. Then it says prepare a statement of retained earnings for the year. So again, think patterns. Statement of retained earnings starts with the calculation. Starts with What?
Adding your net income?
Not necessarily adding the net income. The very top number that we're starting with on the retained earnings statement is beginning retained earnings, right? So we start with beginning retained earnings, then we add the net income or subtract net loss. Now, typically in this class, we don't ever have a net loss, but it's always possible. Then the third line on the retained earnings statement is dividends, if we have any, but if the line is there, which 99.999% of the time it is, just put less dividends and put a 0 if there aren't any, and then we calculate our ending retained earnings. Okay? So you'll see there's your 4910 that we just pulled through from the income statement, subtract our dividends, and get our ending retained earnings balance. Now, I want to show you something here. Make the connections. When you go back up here to the top, to your adjusted trial balance, notice that this retained earnings number right here, remember, that is beginning retained earnings all year long, okay? So that's where that $1,000 came from. And then in this particular case, we do have dividends in this particular question.
You've got the parentheses around your less dividends, so should we put the negative even though we put less dividends? Because mine doesn't parenthesize, but I still have the same answer as you.
You have to watch it. I would say consistently key it in as negative 300 so that it shows the parentheses. Because that way, mentally, when somebody's looking at that column of numbers, when they see the parentheses, they know that that's a subtract, even though the title says less dividends. But the other thing is, and just be aware of this, sometimes if you keyed it in as just simply 300, even though it says less dividends, sometimes the programming behind the scenes will add it. So you just have to be really careful when you're keying in something like that, okay? Again, you know, we report it, all these little tiny things that we hope that they'll fix, but, okay? So then there's the statement of retained earnings. Then that gets pulled through to the balance sheet. Good, right? And then we key in the balance sheet. Now again, notice this balance sheet, one, they put it in just a single columnar format, which is totally fine. The last one that we did, we basically put it in 2 columnar format because we put assets on one side and liabilities and equity on the other. This one, we're just putting in a single columnar format. Now again, also remember this. Remember, this is practice. So at any point in time, if you want to get back to being able to see this information, let's say that, you know, we're talking about it in class and you're like, yeah, I got that. You didn't make any notes or anything, and then all of a sudden you get home and you're like, oh, wait. Remember, you can always go back up to the top right. You can hit the submit button, right? And then go back in, and I think you start with view report from that item so that you can go back in and you can see, we'll confirm it before you leave, but you can go back in and you can see it and you can open up, you can toggle between show my answer and show correct answer, okay? And when you click on show correct answer, it's going to give you everything here, and then you can go back through it and look at it again, okay? So just if you're going to make notes or anything, I would say stay engaged in class, make a note of it's this question, balance sheet, you know, whatever, and then you can go back in and look at it. But again, we'll double check that so you make sure that you know where that is, okay? So then we got the balance sheet. Now the balance sheet balances, okay? So at that point, we know that everything balances, and in this particular case, notice that we are at the end of the year, December 31. So to finish up this year, the only thing that we need to do is we need to update the retained earnings balance. Okay? Now, this, for whatever reason, I'm just going to tell you, for whatever reason, this one journal entry seems to really throw you guys off. Okay? So stay engaged rather than worrying about getting anything down. So understand what's happened here. We had, there is our adjusted trial balance. That's the data that we used to make our financial statements, right? Now, what we need to do is remember when we reported that statement of retained earnings, right? The ending retained earnings was basically this $1,000 minus this $300 plus these two revenue accounts minus those expenses, right? Because it was beginning retained earnings, which is the 1,000, minus, well, excuse me, add net income, which incorporates this group of numbers, just net, and then we subtracted the dividends, which was this number right here. You with me? That went, so when we got down here to the end of the retained earnings statement, we had a balance of 5610. But currently, don't miss this, currently the balance in retained earnings is $1,000. So how do we get the balance of $1,000 to show that 5610? Okay, you with me? So right now the balance in retained earnings is $1,000. We need it to say at the end of the year, this is the only time that we do this. At the end of the year, we need the retained earnings balance to be 5610 so that we zero out all the revenues, all the expenses, and all the dividends so we can start new for next year. Okay? The way that we do that, we do it in two journal entries. One, we need to close revenues. So if revenues normally have a credit balance, we would close them to zero with a debit. We've got to close expenses. So if expenses normally have a debit balance, we need to close them with credits. Okay? You with me? And dividends normally have debit balances, so we need to close dividends with a credit. We do it in two journal entries. Okay? So when we come down here to the journal entry, there we go. We're closing out the revenues. We're closing out the expenses. And notice something here though. It's really subtle, but you might overlook it. If we take revenues minus expenses, we get 4910, right? To force this journal entry to balance. You with me? We close revenues with debits. We close expenses with credits. That journal entry by default is not going to balance. We've got to force it to balance. And in this particular case, we need more credits to get this journal entry to balance. Does that 4910 look familiar to you? What's the 4910? It's net income. You with me? So we close revenues, we close expenses, we update retained earnings for net income. Then and this is a nice check figure. That's the reason why we do it in two separate journal entries. We close revenues and expenses together. If we had net income, then the balancing number on our journal entry should be a credit to increase retained earnings. Then we close the dividend account. In this case, it was $300 was sitting out there, so we close it with a credit to reduce retained earnings. Right? Big picture. You with me? So remember, retained earnings, if you can make this connection, it's like this will be huge. Remember, right now, retained earnings on that adjusted trial balance has a $1,000 balance in it. We added net income of $49.10. On the journal entry, there's our $49.10 because we're closing revenues and expenses. On our retained earnings statement, we're subtracting dividends here. The journal entry, we're subtracting dividends here. How we doing? Okay. So now, understand at this point, I don't think they don't take it, yeah. They don't take it further. I kind of wish that they would. They don't take it further, but understand, after this journal entry, all revenue accounts on the trial balance are going to have a zero balance. All expenses on the trial balance are going to have a zero balance. All dividends on the trial balance are going to have a zero balance. And retained earnings is now updated to a balance of $56.10. So don't miss the fact that it's like those two closing journal entries are where we're making these updates right here to make retained earnings have a balance in the ledger and on the trial balance of $56.10. So that closing entry is directly related to the retained earnings statement to get that balance and retained earnings updated to what we just reported on the financial statements. How we doing? This is one where a lot of times it's like your brain gets tied in a little bit of a knot. Okay? We got a few more minutes. Let me see if I can find another one. So we'll work on all of this again, so just in a bigger format, and we'll have a really nice long problem next class. All right, so let's take a look at this one, because again, I want to go back to looking at adjusting journal entries, so you're kind of getting a feel for what adjusting entries are doing and why we need them. Okay, so we've got Dyer Incorporated. This is question 50. What did I say? 57. Completed its first year of operations on December 31 of 2024. Now let's stop right there. Don't skip over all that good information that they just gave you in that sentence. We've got Dyer Corporation. We completed its first year of operations, so all beginning balances were zeros. We just started into business. This is our first full year of business, so all beginning balances were zero. Because of this, the end of the annual accounting period, the company bookkeeper prepared the preliminary income statement. All right, so we've got the preliminary income statement. Okay, we've got our rent revenues, we've got our expenses, we've got some net income here. Now, I want you to stop and think about this one though. When it says, because again, in accounting class, vocabulary is absolutely essential. Okay? What's included in these numbers on this income statement? What all have we done up until this point to get to these numbers? Huh? Beautiful, yes. Unadjusted numbers. Okay, so when it says that you've got a preliminary net income statement, that means that the only thing that has been done is those daily entries in my round one on that document that I keep going back and referencing. Okay, so when it says preliminary income statement, that means only daily work. That means cash receipts, cash disbursements, billing customers for work we've already done, and recording invoices from vendors where they've provided us with something. Okay? Then it says you are an independent CPA hired by the company to audit the firm's accounting systems and financial statements. In your audit, you developed additional data as follows. Okay? So they gave you the data, and they're going to ask for the journal entries. Okay? So let's look at item number 1. It says wages for the last 3 days of December amounting to $310 were not recorded or paid. Okay? Now again, think about what this is really saying. Everybody got paid, and then just the way that the month end laid on the calendar, we had 3 more days at the end of December that everybody came into work. But we're going to pay them in January for those 3 days that they worked in December. Okay? Do we have a journal entry? Yes, we do. Okay? Let's drill it down. Is it an accrual journal entry or is it a deferral journal entry? Oh, darn it. I knew she was going to ask that. Good. It is 310. The amount of the journal entry is 310. All right? So let's back it up then. All right? Let's do the journal entry first then. All right? I'll go with it. So the amount of the journal entry is 310. What does it go to? What does the debit and credit go to? Beautiful. One's wages, see, I'm loving this. One is wages payable, one is wages expense, right? Okay, somebody help her out. The debit goes to expense because, again, think about what that trial balance looks like, right? Those expenses are always over here on the left-hand side. So there is our journal entry. Okay. Is it an accrual or a deferral? It's an accrual. Why do you know it's an accrual?
Because you get it now, you pay later.
Keep talking.
Like accrue the expense later.
No. We're not going to accrue anything later. When we make this journal entry of 310, that means the expense has already been incurred, but we're going to pay it later, right? Okay, so this is another slight distinction that if you want to get this in your head when you're trying to determine the difference between an accrual entry and a deferral entry. When you've got a deferral entry, remember, both of these are a two-step process. When you've got a deferral entry, you've usually got cash happening first, and you're booking some sort of asset or liability, and then you're either moving the asset into an expense or you're moving the liability into revenue as step 2. You want me to repeat that? On the deferral side, okay, when we're dealing with deferral entries, you've usually got cash first and some sort of asset or liability showing up. Then the second step, you've either got that asset becoming an expense or you've got that liability becoming revenue. Okay? So you've got something hitting the balance sheet first. Okay? When you're dealing with an accrual, it hits the income statement first. Then later it affects cash, whether it be a payment or a receipt. You with me? So on this one is an accrual entry because we will pay these wages later. Okay. All right. Let's look at B. The $400 telephone bill for December has not been recorded or paid. Do we have a journal entry? Yes, we do. How much is the journal entry? $400. So I'm just telling you, don't ever leave anything blank. Even if your brain goes blank and you can't remember what the accounts are or which direction they go in, whether, which one's the debit or which one's the credit, give me numbers, okay? You get half the points, okay? So we've got a $400 journal entry. The debit goes to the expense. Now, it just depends on how they want to record this. A lot of times it might be some kind of telephone expense. It could qualify as a utility expense, something like that. Just be aware, though, this. When we get to the point, we'll take a quick peek at our exams and everything next class period. When we get to the next class period, if you have a journal entry like this, that you're sitting there and maybe they're looking for telephone expense, but you put it in utilities expense, or vice versa, I'm going to give you points for that. The computer is not, but I will, because it's logical. It makes sense. Okay? So we've got the expense is getting the debit or credit. The debit and the credit goes to? Good, accounts payable. How we doing? All right, is that an accrual or a deferral? Good, it's an accrual. It hits the income statement first. All right, C. We've got depreciation of equipment amounting to $23,000 for 2024 was not recorded. So, sweet mercy again. We hired the worst accountants ever, and they just let those assets ride. How much is the entry? $23,000, so give me a debit and a credit. Debit goes to? Good, depreciation expense, and the credit goes to? Accumulated depreciation. Accrual or deferral? She's hiding behind her. Good, it's a deferral because it showed up as equipment on the balance sheet first, right? Okay, and then we're moving it off the balance sheet onto the income statement. Good. All right, D, interest of $500 was not recorded on the notes payable by Dyer. Do we have an entry? Yes, we do. How much is the entry? $500. What does it go to? Good. Debit to the interest expense and credit to interest payable. Good. Accrual or deferral? Good, it's an accrual. That feels different because normally we would call that a deferral because something happened on the balance sheet first. I get that, but not this time. A little tricky on that one. Notes receivable, notes payable, the interest is an accrual, okay? All right, let's see. E, rent revenue account includes $4,000 of revenue to be earned in January of 2025. Now this one is actually a little tricky for a few reasons. So first, let's ask the question, what year is this? What year are we in? 2024. In item E, it says the rent revenue, that's this number right here, this $114,000, says the rent revenue account includes $4,000 of revenue to be earned in January of 2025. Good. It should be deferred revenue, okay? But here's the little bit of a trick here. This is actually what we call a correcting journal entry, okay? It's a little bit like, probably what happened here is something like this. They prepaid their rent and our bookkeeper or accounts receivable clerk just coded it directly to, all of it, to rent revenue. But when we got down, as accountants, when we got down to the end of the period, we looked at that and we said, is $114,000 correct? That seems a little high. And what the problem was is that that extra $4,000 was sitting in there. So now, this is going to look really weird to you. We've got to correct revenue, right? How do we correct it? Good. We've got to debit rent revenue and what's the other account? Good, the deferred revenue. So that's not a typical adjusting journal entry at the end of a month. That's a correcting journal entry. All right. Any questions there? All right. Let's look. Oh, perfect. Item F. Supplies costing $600 were used during 2024, but this has not yet been recorded. Do we have a journal entry? Yes, we do. So the amount of the journal entry is $600. And how do we record it? Good. And the credit goes to supplies. Okay. All right. Item G. The income tax expense for 2024 is $7,000, but it won't actually be paid until 2025. Do we have a journal entry? Yes, we do. How much is it? $7,000. Good. And the credit goes to? Not accounts payable. Nope. Income tax payable. There we go. So just realize that when we're talking about all these payable accounts, there's a couple of things going on here. It's more like they're categorized by who do we owe. So when we're dealing with accounts payable, we're dealing with amounts that we owe to our vendors. Okay? When we are dealing with salaries and wages payable, we're dealing with amounts due to our employees. When we're dealing with income tax payable, we're dealing with amounts owed to the government. You see how this is going? Because a couple of things is this kind of thing, income tax payable, that we know that is going to require an immediate cash outlay with no delay in getting there because penalties on that kind of stuff are astronomical. Okay? All right, how we doing? Okay. Yes, unless we're having to make a correction. So let's say, let me give you one, and it's time, so if y'all want to stay, you can stay for the explanation. So let's say, for instance, that we make a payment, right? And we make a payment for a couple of different months of rent, but the bookkeeper codes it all as rent expense. 1 month later, we've only used 1 month of that. So now we got to move it out of the expense and put it back into prepaid rent.
That's what we did.
Yes. But yes, normally expenses are always going to get the debit. Yeah, the recording, sorry. Right here under coursework, Unit 1, Chapter 2, oh, shoot. Oh, hang on. There we go. No. Right here under Chapter 2, Resources, right here, this aloe red, right here, that's your acronym. Assets equal liabilities plus owner's equity. Assets go up on the left, and liabilities and equity go up on the right. Revenues go up on the right. Expenses and dividends go up on the left. Let me just tell you, you would have seen something very similar to this on every single one of my accounting exams when I was at Clemson way too many years ago.
If